Hello, welcome to this course on performing risk assessment procedures. This course reflects the recent changes that have been made to CAS 315. My name is Jennifer O'Neill, and I'm happy to be here with you to walk through this course on performing risk assessment procedures. So a little bit about me. I came up through the CA route many years ago, started my career with Doane Raymond, who then became Grant Thornton. I left there as a senior manager, decided to go into industry, but didn't take long to realize that public accounting was my calling. So I did work with Collins Barrow up in the beautiful Kawarthas for a few years, and then upon returning to the big city, started working with RSM Richter. So I was primarily in the professional standards group there, and after about 6 years, Richter merged with EY. So about a year and a half after that, I decided to move on. So for the last number of years, I've been working with CPA Canada, writing the Professional Engagement Guide and the Quality Assurance Manual, and most recently authored the Quality Management Guide. So just the changes that have been made to CAS 315 are quite substantial. And what we've tried to do in this course is really focus on how you can apply those standards. This means that we are not just going to be talking about CAS 315, but also the other standards that need to be addressed at the same time, such as the standards on fraud, accounting estimates, related parties, and going concern. So let's get into it. In this module, we're going to provide an overview of the risk assessment process. And then in subsequent modules, we're going to dive deeper into each of these steps and then use a case study to illustrate the application. So the objective of performing risk assessment procedures is to provide an appropriate basis for identifying and assessing the risks of material misstatement, and that's whether they're due to fraud or error at both the financial statement and assertion level, and then to design further audit procedures to obtain evidence to support the audit opinion that are responsive to those risks identified. When you're designing and performing risk assessment procedures, you are obtaining evidence about what types of risks exist and may have the potential to impact the financial statements. So it's important to remember to use your professional skepticism. That is, you need to use a questioning mind, a mindset that considers not only evidence that may be corroborative, but also considers evidence that may be contradictory. So when you're performing risk assessment procedures, you're going to use inquiries of management and other appropriate individuals, analytical procedures, and observation and inspection procedures to obtain our evidence. And again, this is evidence to support where risks of material misstatement on the financial statements may exist. So throughout this course, we are going to be presenting how to perform risk assessment procedures. And we're going to go through each of these 9 steps. First, in step 1, we'll understand the entity. And then based on that understanding, we will identify risks of material misstatement. In step number 2, we're going to understand and evaluate those pervasive control components. And we're going to talk about the fact that if there are deficiencies in those control components, that will likely lead to a risk of material misstatement at the financial statements. So we will go back and identify those risks. So as we go through and identify risks, we are going to assess whether they are financial statement level risks or they are assertion level risks. So in step 3, we will assess those risks of material misstatement and determine whether they need any type of overall responses or whether they impact our assessment of risk for the assertion level. So it could create new risks at the assertion level, or it may impact the likelihood and magnitude or our inherent risk assessment for those identified risks. Step number 5 is identifying our classes of transactions, account balances, and disclosures that are significant. Based on those significant classes of transactions, account balances, and disclosures, we'll perform step number 6, in which we will understand and evaluate the information systems and communication. So again, we're understanding here the control component, and those control deficiencies may again result in risks to either the financial statement level or to the assertion level. So we will again identify those risks of material misstatement. So at any point we're going back to identifying those risks, we're going to have to continue to go through these steps. So although we're performing risk assessment procedures in kind of a step-by-step or a linear manner, you can see here that it really is iterative. So you might have to go back up if you identify those risks and then reassess the impact of those risks, both at the financial statement level and the assertion level, which will then again potentially affect those classes of transactions, account balances, and disclosures that you determine to be significant. Step 7 is then to understand the control activities component. And this component is really a little bit different in that we are going to look at control activities only over those risks we assessed as significant, and we'll talk about that in that module, if they are going to be tested as part of your audit strategy. And that is going to include any of those risks that you have identified where substantive procedures alone are not going to be sufficient, and you will have to test those controls. And it also includes any other controls that you may deem as necessary. Then we're going to go through and, based on those control activities, identify potential risks arising from the use of IT. And if we've identified any of those risks, we will then need to go through and identify general IT controls. And then we'll go through and assess the design effectiveness and implementation of those controls. And that's including those control activities that we documented, as well as those ITGCs. And then after that, we can then assess control risk. And we're only going to assess control risk if our intention is to test and rely on the operating effectiveness of those controls. And then based on that, we can then assess the risk of material misstatement for each risk. So our inherent risk is going to be the same as our risk of material misstatement if we did not assess control risk. Now, if we did, we will reduce the risk of material misstatement, taking into account the control risk. So this is really our residual risk of material misstatement, and it's going to drive the extent of substantive testing. And then in step 8, we're going to evaluate those results of our risk assessment procedures. So we're just going to take and go into each of those steps just a little bit right now. And then within each of the modules, we're going to dive in and really understand what's involved. So the first step is to obtain an understanding of the entity and its environment and the applicable financial reporting framework. So this understanding is to enable you to identify where those sources of risk may exist. So for example, you may identify that the economic downturn will have a significant impact on the entity's operations, and that their clients may have difficulty paying their invoices, and therefore collectability of AR may be an issue. But it may also impact the inventory if it can't be sold. So one source of risk can have multiple impacts on the financial statements. We will also obtain an understanding about how management makes their accounting estimates and who the related parties are and what transactions occurred between them. The initial going concern assessment will also be made at this point. So understanding management's assessment of whether there are any events or conditions that may indicate that there is a material uncertainty relating to going concern, and even whether the going concern basis of accounting remains appropriate. So we will talk about this further in the next module, but keep in mind here that when we are gaining this understanding, we are doing so to be able to identify risks. So we're not going to have the same level of understanding as management, and this is not intended to be a book about the company, but we need to know enough to say whether or not there are risks which may impact the financial statements. Then based on this understanding that you just obtained, you can identify those risks of material misstatement. Then at this stage, we're going to assess whether the risks impact the financial statement as a whole, which would be financial statement level risks, or whether they exist at the assertion level. Step 2 is to understand and evaluate the pervasive or the indirect controls. So these are the controls that will impact the financial statements as a whole and generally cannot be associated with a particular assertion. So the three main types of pervasive controls that we need to understand and evaluate at this stage are within the control environment, the risk assessment process, and monitoring controls. Based on the information that we obtained back in step 1, when we were understanding the entity and its environment, so you may have identified financial statement level risks. And you may also have uncovered some of those risks based on your inquiries and considerations for fraud, from discussions around going concern, as a result of non-compliance with laws and regulations. And if you identified any control deficiencies in the control environment, the entity's risk assessment process, or that component on monitoring controls, these will likely have a negative impact on the financial statements as a whole. Now, on the flip side, a positive evaluation may also impact the financial statements, but in a positive way. So we're then going to take that information and assess the risks of material misstatement at the financial statement level, and then determine the impact to the audit. So this may result in overall responses, such as increased supervision, using more experienced staff, or reminding staff to use their professional skepticism. However, it may also impact the assessment of risks at the assertion level. So, for example, you could have a financial statement level risk that may be that management has a bias to increase profits in order to meet a banking covenant. And this would be a financial statement level risk. However, it would also have an impact on the accounting estimates, which impact the assertion level, such as the allowance for doubtful accounts and the net realizable value of inventory. Step 4 then is to identify and assess risks at the assertion level. And these ones are the risks that can be linked directly to an assertion within a class of transaction, account balance, or disclosure. Now, assertion level risks would be identified again through our understanding of the entity and its environment, and as well through understanding potential non-compliance with laws and regulations, including those that were going to have a direct impact on the amounts recorded in the financial statements, fraud inquiries and engagement team discussions about the specific areas that are susceptible to fraud, your understanding of accounting estimates that are used, particularly those with subjectivity and complexity, your understanding of related parties and transactions with those related parties, and your understanding of the business processes, including the information system that supports those processes and communication of information, which we're going to be covering in step 7. Now, in the financial statement level, we assess the risk of material misstatement, which also took into account the pervasive controls, both the good and the bad. When we assess risks at the assertion level, we're separately assessing inherent risk and control risk. So in this step, we are focused first on assessing the inherent risk. And we do this by considering the likelihood of the risk actually occurring, as well as the magnitude. So how much would it impact the financial statements if it were to happen? And we will also consider those risks identified at the financial statement level and whether they increase the likelihood of the risk occurring. So inherent risk is going to be assessed on a spectrum of risk. And this recognizes that some risks are much more likely and have a more significant impact on the financial statements if they were to happen. And those risks would be on the upper end of the spectrum of risk, and we are calling those significant risks. So risks identified as significant risks will require procedures to be performed that address the risk specifically. And in step number 5 of performing our risk assessment procedures, we are going to then identify both material and significant classes of transactions, account balances, and disclosures. So a significant class of transaction, account balance, and disclosure is one that has a relevant assertion, and that is an assertion that has an associated risk. And this assessment will drive, number one, the information systems that we need to understand. That's going to happen in the next step. And number two, the audit work that's going to be required in order to obtain sufficient appropriate audit evidence. So now in step 6, we're going to take those significant classes of transactions, account balances, and disclosures, and we're going to understand and evaluate the information processing activities, including the business processes, the financial statement close process, and how journal entries are used. And then we're going to obtain an understanding of and evaluate both internal as well as external communications. Now, I'm just going to stop here for a moment to clarify something. So far we have presented the risk assessment process as a linear step-by-step process. However, in reality, it is a very iterative process. Now, in this step, you may identify additional risks of material misstatement at both the assertion and the financial statement level. So this will then require you to go back to the appropriate step to assess those risks and ensure that you have sufficient evidence around the risk. Then once we have identified all of the risks and have performed our assessment of inherent risk, we can then move on to our last component of internal control, which is control activities. We are not required to identify and assess all control activities. We are only required to identify control activities over those risks we assessed as significant risks, controls that we are intending to test for operating effectiveness, controls over journal entries, and other controls that you may deem to be appropriate in the circumstances. So this may include controls over risks that have a high inherent risk, but not assessed as significant, or any other controls to meet the objectives of the standard. Now, it is these control activities that we then need to assess for design effectiveness and implementation. And this will involve obtaining evidence other than that initial inquiry that the control was actually in place and working at a point in time. And then this step goes a little bit further because based on those controls that we identified, we now need to understand the impact of IT on those controls, whether the control is automated or manual, as well as whether the control relies on information produced by the entity's information system. And this will have an impact on the associated risks arising from IT. And it's those risks arising from IT that we need to then understand controls over, which are called general IT controls. And again, we will assess the design effectiveness and implementation of those general IT controls. Then once we have all the controls documented and evaluated, we can then assess control risk. So control risk is only required to be assessed when you plan on testing the operating effectiveness of controls. And that the initial expectation of the operating effectiveness of controls is based on your evaluation of that design and the determination of implementation of the identified controls in those control activity components. So inherent risk does not change. However, if you have assessed control risk, then the residual risk of material misstatement will be the level of work that substantive procedures will need to address. If you haven't assessed control risk, then inherent risk will be the same as your risk of material misstatement. And then step 8, our final step in the risk assessment process, requires us to do a stand back to see if we may have missed any risks. We're going to review the material classes of transactions, account balances, and disclosures, but are not considered significant, and then evaluate whether that remains appropriate. Now, this is an important step as the material and significant classes of transactions are going to form a basis for designing and performing our further audit procedures. So if any risks appear to be missing, We're then going to go back to step 3 or 4 and ensure that we have appropriately documented and considered all of the risks. And this will bring us to the end of our risk assessment procedures. The next step will then be to determine the appropriate further audit procedures to perform that are responsive to those risks that we identified. The following modules then are going to take us through each step of this risk assessment process.